Dapper Dividends coming at you again. What's going on, everybody? Thanks for coming back, checking us out. This is a commenter's suggestion here. Mr. Vinval, he wanted to hear about ticker symbol ARCC, Ares Capital Corporation. So we're going to do a listener request. We're going to go out to the live line here and do a listener request for ARCC. So let's get to it. Ares Capital Corporation is a $7.6 billion mid-cap. They are a business development company. You may have heard BDCs. They specialize in acquiring, recapitalizing, mezzanine debt, restructuring, rescue financing, and leveraged buyout transactions of middle market companies. So what is a BDC? A business development company is an organization that invests in small and medium-sized companies as well as distressed companies. A BDC helps the small and medium-sized firms grow in the initial stages of their development. With distressed businesses, the BDC helps the companies regain sound financial footing. So it's a little bit risky right off the bat what BDCs do. They are trying to rescue companies. They're trying to finance companies, trying to help struggling companies that are in distress grow. That right there is risky. So right off the bat, just know that BDCs have very high risk, but very high reward. And they also have high dividend yields, as we'll see here in a second. BDCs also must invest at least 70% of their assets in private or public U.S. firms with market values of less than $250 million. So pretty small companies that they are trying to rescue from distress. So these companies are often young businesses seeking financing, or they're firms that are suffering or emerging from financial difficulty. Also, the BDC must provide managerial assistance to the companies in its portfolio. Again, a lot of risk. Putting money into distressed assets is very risky, but a lot of room for reward. Now, they are currently paying a very, very stout 8.84% yield, which is currently $1.60 a share. The 10-year compound annual growth rate is only 1.8%. That's not a lot. I don't like to see something that low. And they did cut the dividend 5% from $1.68 that they had paid in 2019. The dividend has roughly been flat, as you can see here, since 2013. So BDCs, they have a very high yield, but again, they're risky, which is a recurring theme throughout this, is the risk that they are leveraging their loans to companies that are very risky, that are in financial distress. And these assets, if they decline in value, that's really negatively going to impact the BDCs like Ares Capital. Check this out. The BDC dividends are mostly taxed at ordinary income tax rates. However, a portion of the prior year's dividends may be designated as return of capital, which may be treated as a capital gain. The return of capital payouts reduce your cost basis and are not taxable until you sell your shares, when they are taxed at the appropriate capital gains rate. So that's the issue, is the dividend tax treatment here, especially with Ares Capital. So what I really want to stress here is the tax treatment of the dividend, in particular to Ares Capital. As you can see here, $1.60 is paid out, but 99.6190% of that dividend, or $1.6736, is not qualified. That means you will pay your ordinary income tax rate on those dividends of the $1.67 and some change there. You're paying that at your ordinary income tax rate, but 0.03810% is qualified and eligible for the dividend received deduction at 20%. So really, you're paying almost the full dividend as your ordinary income tax rate. And that's just, it's silly how that works out. But, you know, if you have a lot of money invested, maybe it'll make sense or make a difference, a significant difference. But basically just assume that you're paying 100% of the dividend as non-qualified. The current payout ratio is 220% and expected to be 93% in 2024, according to Simply Wall Street. Now, they do have $14.5 billion in long-term assets versus $7.70 billion in long-term liabilities. Again, they have a lot of leveraged risky debt in my opinion. And it's just not something that I am interested in investing in. Now, 15 analysts on Yahoo do give it a strong buy rating, but it's just too much risk. That is a very tempting yield, but to me it looks like a yield trap. At best case, they're just going to keep it flat. They're not really growing the dividend, which is what I'm about. I love my dividend growth. And overall, the last thing I want to say to you is if you do hold non-qualified dividend paying stocks or companies like Ares or like Realty Income, I would strongly recommend and suggest looking at holding those inside of a tax-advantaged account like a retirement account, as you are not going to have to deal with paying income tax on those dividends until you sell those years and years down the line. Then you're just going to pay the capital gains on whatever your accumulated value is, and you're not going to have to deal with the headache of paying non-qualified dividends. And there is really no tax benefit to holding them within a non-tax deferred or tax advantaged account. So that's it. That's all it is for Ares Capital. I'm not buying. I'm not going to buy. It's a thumbs down for me. But again, I can understand if you're younger and you want to take that risk. I'm just not that type of investor where I'm at in my life. I'm not going to take on that much risk for a yield that's over 8%. The most I will do is AT&T. I think they have a safe dividend, and at least those dividends, though, are qualified, and I will pay a much smaller income tax rate on those dividends. So I hope you enjoyed this. Expertise always comes from the community. Give me your opinions and suggestions, comments, and concerns for something you'd like to hear me talk about in the future. And follow me on Twitter at RustyRam78. Let's talk, let's chat. You can hit me up on Instagram at Dapper Dividends. Thank you for watching. Thank you for spending a little bit of your time with me. You could have been watching anybody else in the entire world right now, and you're listening to me. I thank you for that. I would love it if you would like and subscribe so we can keep having these conversations, and I will talk to you in the next video.